Welcome back, everyone, to the fourth session on day one of the Modern Investor Summit. I'm Theodora Lee Joseph, Global Markets Analyst at Finimize, and I'll be your host for this session. I'd like to start off by thanking our summit session partner, Oakley Capital. Oakley Capital is a leading private equity firm specializing in fast-growing mid-market companies in the tech, consumer, education, and business services sector. Now to housekeeping. If you haven't already, please introduce yourself in a chat box with your name and where you're tuning in from. This will be a 20-minute discussion followed by 5 to 10 minutes of audience Q&A. So if you've got a burning question, don't forget to ask your question in the Q&A box below. Now I'm joined today by our special guest, Steven Tredget, who is partner at Oakley Capital. For 15 years, Steven was one of the leading capital raisers for public companies, floating and raising funds for over 300 listed businesses. This changed with the recognition that private equity provided superior funding solutions and returns. So as a result, he joined Oakley Capital as a partner in 2017. Today, we'll be discussing with him key trends impacting private investment markets, what makes private equity so appealing, and how retail investors like you can tap into opportunities in alternative markets. Steven, very nice to have you with us today. How are you doing?
Theodore, I'm doing very well, and thank you to you and Finimize for inviting us to join you on the summit today.
Our pleasure. Well, today's session is obviously titled Uncovering Hidden Market Opportunities, and you're here to share with us about private equity. So what's the hidden opportunity here?
Yes, absolutely. Well, I think the first thing is kind of in the context of this discussion, what do we mean by private equity? And I think that's quite a broad church. It can go anywhere from kind of any share of a private company through to angel investing, through to large global PE firms. I think for the benefit of this discussion, we are talking about institutionalized private capital, so large pools of capital that are invested by private equity managers in the shares of growing private companies around the world. It's an important asset class for two reasons. One, it's roughly a fifth of companies by GDP are now PE-backed in developed countries like the US and the UK. And more importantly, these are companies or sectors that are underrepresented on the stock market. And secondly, PE has been one of the top performing asset classes for decades. If you look more recently, you look at the last 5 years, the global PE index has grown at double the rate of the public equity equivalent. So why is your question, why is this hidden? Well, access to private equity is largely walled off to retail investors. It requires personal connections, a minimum investment of anywhere between $2 to $10 million, and the ability to have that level of investment locked up for 10 years, up to, if not longer than. So what's the opportunity? Well, in short, that's listed private equity. It sounds like a bit of an oxymoron, but that's investment companies that are listed on the stock market that are invested in private equity funds. So thereby giving shareholders access to PE performance for as little as the price of a single share.
Great. So in short, you're saying you don't need to be a millionaire in order to invest in PE.
You don't.
Fantastic. Now that we've cleared the air, maybe it'll be great to hear about what you do. You work at Oakley Capital. Can you explain a little bit more about what your firm does and what you do on a day-to-day basis?
Sure. So let's start by introducing Oakley Capital. So that manages 11 billion of our investors' capital. And as you said right up front, we invest this by taking majority stakes, and that's key as we go on to talk about this opportunity more in fast-growing, medium-sized private companies, and that's largely throughout Europe. And today we have 28 such companies that are currently invested in 4 sectors, as you mentioned. And just as importantly, we have a team of 50 that are actively working to help grow and develop those businesses, which is another kind of key thing we'll come on to talk about. And I spend much of my time speaking with and advising the large global institutions, so pension funds, insurance funds, etc., with billions to invest, and groups that have been increasingly allocating more and more of their funds to private equity. The other thing I do is speak a lot on behalf of Oakley Capital Investments, and let's make the connection now to the stock market. So there's an investment company, Oakley Capital Investments, or OCI as it's referred to, which is listed on the London Stock Exchange, and that invests in the Oakley funds.
Great. I know private equity is really interesting, but you know, as a retail investor, you also will have tons of investment options from public markets to choose from. Why PE?
I'd say there's three choices, but putting aside, I mean, I guess the key reason is outperformance. But I think there's the why PE is, initially it's why not PE. As I said, a big chunk of the economy is exposed to private equity. If you're not getting exposure to it, there is a group of a section of the economy that you're not tapping into, whether or not it outperforms public equity or not. Then there is outperformance. So then, why is there outperformance? I think firstly, there's three risks: bigger choice, the types of companies that you get exposure to, and then there's value creation. And if I touch briefly on those 3 points, so bigger choice, essentially, and I'm not advocating for not investing in publicly listed companies, nor should they, be replaced instead of private equity. But the number of listed public companies is shrinking significantly. Whether here, in the UK or in the US, there is a fast-growing AIM market, it's called, here in the UK. The number of listed companies on that have halved over the last 10 years. The same is similar stats for the US. And in the meantime, the number of companies remaining private and seeking institutional private equity is growing significantly. So as a result, there is a wide range of choices of private equity investor, not only those that have already been backed by private equity, but a whole slew of companies that have yet to seek institutional capital. And why are they not seeking to go public, which is key to the opportunity that private equity kind of represents, is it's a long list and a whole lot of discussion about the cost, regulation, disclosure, the time consumed by quarterly reporting, the thousands of potential shareholders, all of which that come with being publicly listed. And then add to that the kind of daily pressure of live pricing of your equity. Now, some may see that as a great discipline, but what it can also lead to is short-termism and kind of growth at all costs on behalf of management, which isn't always to the benefit of companies. And so private equity, can often referred to as patient capital, can take a much longer term view on those companies and not be so short termist. So there's kind of bigger choice and a shrinking cohort within the publicly listed space. And then there's a type of companies, not exclusively, but you tend to find companies that more often than not reflect the kind of new economy companies, so more tech-related companies. You'll also find sectors that are just not currently represented. They may do, and they may be represented on the stock market in a relatively small way. If you go back 10, 15 years, healthcare was very much the preserve of private equity. It's now increasingly available on the stock market. There are many other sectors. We happen to specialize, as you mentioned, in education amongst our 4 sectors, and particularly ed tech. There is little exposure to that if you look at the kind of main developed stock markets, particularly US and the UK. And then thirdly, I mentioned value creation. And this, I think, is the kind of one of the most important points to reference here around PE. It's having some control of your own destiny. As I referenced earlier, we're talking about majority or control stakes in these companies, so over 50%. And that gives us the opportunity to use our expertise and our skills to help create value and grow the quality of the earnings of these underlying companies in conjunction with the owners of these businesses, the founders of these businesses. We're doing it in an aligned way with them, but it is in the ability to improve on senior management, help them with M&A, kind of buying and building. It is about improving the quality of earnings, introducing a subscription nature to earnings. The list goes on, internationalizing or digitalizing, a whole bunch of things that as a public equity investor, without that level of control, you can never influence the outcomes in that way.
Yeah, so true. I guess the other beauty about PE is that, as an asset class, it adds diversification to your portfolio just because of the low correlation it has to the markets in general. So there's always a space for alternative investments like PE in your portfolio. There was another interesting thing that you mentioned. You talked about how, in public markets, actually a lot of the value creation is done in PE before companies, go private. I think now we're starting to see bigger firms, IPO with like multi-billion dollar companies. They're not coming in as a $1 billion kind of IPO. It's like it goes for 20 billion. A lot of that, value creation returns you actually realize in the initial stage before the company goes private. And I think that value creation aspect is very important. So I want to bring this a bit closer to home. You've worked on a lot of deals yourself. Can you give us an example of a deal where you saw you added significant value add and returns enhancement?
Yeah, I mean, you'd expect me to say that, of course, we always add significant amounts of value creation in any deal. But let's give one example. A Canadian headquartered business, but a global business, and a management team that we knew as a result of working with a number of the team here in the UK and in Europe. And it's a business called Tech Insights. And Tech Insights, at its core, breaks down at a molecular level the semiconductors. Semiconductors is prevalent in mobile phones. And why does it do that? It does it to understand and identify the IP within those semiconductors. It's a highly skilled business. It incurs multi-million pounds of equipment and skilled engineers to do so. When we acquired that business, it was an attractive business back in, I think, something like 2018. It was growing, but it was very lumpy, unrecurring revenue. So essentially, it was Apple wanting to have, kind of project-based a project with us in which it wanted to know what IP was in a competitor's phone to understand whether or not its IP had been infringed, and therefore it was used in order to use that in a court of law to defend their IP and to essentially, kind of sue competitors. That's not a real life example, but an example. So lumpy, one-off, large kind of revenue. 3-4 years later, we had done the following to that company. So the key thing is we had turned their revenue model into more of a subscription model. So taking all that incredibly rich content and put it into a library that you would subscribe to get access to. So going from 10% recurring revenue to, by the time we sold a stake in that business, it was 70% recurring revenue. For having a small number of operators within the semiconductor world to having 200-300 OEMs all subscribing to this library. We increased the senior management in total and in quality around the kind of core execs that we had backed. And we also helped them with M&A. So this was about increasing the product range and increasing the data available for subscription on the platform. All of that led to us in that 3-4 years kind of making 19 times our money. Now, yes, it was always a growing business, and it's now a much bigger company. And so, its earnings increase alone would have helped to do that. But one of the key things is the quality of the earnings, the client diversification behind those earnings, and the recurring nature of those earnings led to a significant increase in the valuation multiple that business could now attract.
19 times returns. I guess those are the kind of returns everyone can get on board with, but it doesn't happen every day. So definitely not in public markets, apart from the rare few. And the case study that you gave just, I guess it just kind of goes against the traditional stereotype that people have that PE firms just, the only kind of value creation, quick and easy money is by over leveraging, a company through financial engineering, stripping the company and then exiting it. So that's a very interesting case study. We talked about PE outperformance compared to public markets. My question for you is whether you think that this outperformance can be sustained. And I'm asking this with the backdrop of higher for longer interest rates that we're seeing now. Lots of companies, even public companies, are suffering. Companies can't invest as freely. Capital is expensive. Money isn't free now. We've got the risk of a recession. Are these things likely to impact private equity returns? And what are your expectations for market private capital returns?
Yes, I mean, as Ray Dalio said earlier at the opening of the summit, I mean, macro drives everything, and so few escape the headwinds of recession or inflation or the higher cost of debt or the other kind of elements that you mentioned there. So how do we? I guess in answer to your original question is, can we still generate attractive returns regardless of that backdrop? It's harder for me to kind of speak more generally about private equity. As you can imagine, it's a diverse asset class. I talk from our perspective and why we think we can generate returns. And there's kind of two elements to think of. The companies, we have the 28 companies we've backed now, and why I think they can outperform. And then, of course, difficult market backdrops like this also present opportunities. And so one of the things, if we think about what we particularly look for in investments, the first thing is that they have to be founder backed, and we are working alongside it. They are rolling on the same terms as us, with a clear strategy for the kind of next 5 years, of which there's a minimum, assuming that we are operating in a recessionary environment with very little M&A and high interest rate costs, and we achieve no multiple expansion at the end. We have to be able to still model that our base case is that we can make 2 times our money on a 3-year view. So I guess my point being, in terms of what do we anticipate we can still generate in returns, we should be able to generate, a 25% IRR over the course of a modest hold period, 3 or 4 year hold period. And so that holds in the environment that we're talking about now. So why does it hold? Much of the companies that we are investing in are digital disruptors. So they have a solution in a pre-existing market that is going to, make the lives of businesses easier or consumers easier, or give access to a particular market in a more seamless and frictionless way. And that disruption means that we're not relying upon market growth per se. We are relying upon this company to take market share. So to give you an example, we're investing behind a number of mega trends, kind of businesses increasing shift to cloud solutions, consumers shift to online solutions, and the kind of growing global desire for high quality accessible education. So they're what we're trying to kind of pitch ourselves towards. And to give an example of a market that maybe isn't growing, but the underlying companies we're investing in is growing, is we for many years have invested in price comparison websites. Now, well known about there in the US and the UK, and it's a relatively mature market. But there are plenty of places globally and in Europe where those solutions are not well adopted. Take, for example, Italy. Only 40% of Italians have done any kind of e-commerce, of any kind. And then take a vertical, take car insurance. Even after the pandemic, and with an increasing adoption of online solutions, it's less than 20% of car insurance is arranged online. take here in the UK, 80 to 90% of car insurance is arranged online, either direct through an insurer or through a price comparison website. We are the investor in the number one price comparison website in Italy called Facile. And it has grown over the 10 years that we've owned it, 20 to 30% its earnings every year. Has the underlying market grown for car insurance, broadband, utilities? No. I mean, at best, flat. And, during a recessionary environment, it's down. Now, but of course, the shift to an online solution has been growing significantly fast, and that market has quadrupled over the period of time that we've been investing in the business, and will continue to do so regardless of the macro environment. The other point, I won't label it because I feel I just made it, is that why we believe you can perform, particularly in small to medium-sized companies, despite the macro environment, is again the ability to add value. As you rightly point out, very large businesses that are professionalized, that are established, they'll be slightly, slower growing, other than some very extraordinary examples. When it comes to small, medium-sized or founder-owned businesses that have only been owned by a founder, there is a lot of low-hanging fruit, a lot of easy ways to improve the quality of these businesses and to help them to grow, to bring kind of focus and expertise on digital marketing, to focus on D2C solutions, to look at international opportunities, to bring on lower price buying, lower price competitors to help grow the businesses. I won't labour that point more, but you understand the point. There's many ways to create value within a business without relying upon the kind of economic growth. The other point to say is, at this end of the market that I'm talking about in private equity, debt is a less utilised lever. So rarely do we use debt at the point of acquiring a business. And if we look at our realised returns, and they're about 7 times money, 66% of those returns is thanks to the organic growth of those businesses. Basically, the business is growing. 1% of the returns is thanks to the use of debt. And then, and sorry, Theodora, the other thing to say is, whilst we focus on the existing businesses and how they might perform in this environment, of course, the thing that is often not focused about private equity in a high cost of debt environment, it means that private companies that have previously not been backed by public or private equity, other than their own kind of personal investment, have relied heavily on cheap, no low cost debt to grow. That's no longer available. Their balance sheets now are distressed, highly levered, and they need to seek another a solution for capital growth, for growth. And so private equity becomes one of only a few options available to them. So that dislocation in the market at the moment is actually providing private equity, particularly at this end of the market, with a lot of new opportunities.
Great. I guess what you were saying is not too far off from it's basically what Warren Buffett has espoused in terms of finding good companies with good moats, and they're going to perform well over a long time, regardless of the macroeconomic environment. You want companies to continue to grow, where their managers can influence the operations of the company, and it's not the macro driving fundamentals. And interestingly enough, that hasn't been good companies with strong moats hasn't been completely easy to find in public markets, considering that a huge part of the S&P returns have been driven by multiple expansion as opposed to earnings growth. So the stringent criteria, I guess you mentioned about your portfolio companies, that's really interesting.
And it's a great point, if I may. I mean, if you take the average earnings of the Oakley portfolio, it's about 20% earnings growth on average, organic. And those businesses are held roughly on about 15 times EV/EBITDA, with net debt on average about 4 times. You take those KPIs and compare them, let's say compare them to the NASDAQ, you may have the NASDAQ KPIs to hand quicker than me. But the last I looked, that average growth rate is somewhere between 20-40% higher than the Nasdaq, and the multiple is a similarly lower, significantly lower than the average multiple on the Nasdaq.
Great. Steven, that was super insightful. We've got a couple of questions from the audience, but before I jump into that, you mentioned about, we've seen how attractive PE is as an asset class. You said that, you don't need to be a millionaire to invest in PE and be exposed to alternative asset classes in your portfolio. One way of doing so is via listed PE, like Oakley Capital. What are the risks involved investing in listed PE companies as opposed to actually in a PE firm or trust itself?
What's the risk of being enlisted PE? I mean, that is essentially the risk of investing in any share. I would argue that they may go up as well as down. One of the greater risks for me of this is it's not worth it. It's the opportunity and risk, I think, of listed PE is that private equity isn't particularly well known by its nature, because these companies are private and they want to keep advantage of their private intelligence and information and knowledge. You don't want to share it with all your competitors. There's not, perfect transparency through to the underlying companies. We give a reasonable amount of information, but you don't know, exactly, kind of to the detail, the performance you would if you were to buy a publicly listed operating company. So I think when you've got a lack of understanding or a lack of knowledge, I should say, about a particular space, and it's a sector which, listed here in the UK and the US, is a relatively small sector. So it isn't necessarily attracting a huge amount of attention at the moment. If you have that lack of understanding, plus a media which tends to write more negatively than positively about private equity, that can create shifts in sentiment that can be quite impactful on the sector. Now, it's an opportunity because I firmly believe that as more retail gain access to private equity by listed PE, we're going to increasingly see the value of these businesses and more assets of this kind, listed in the public market. And so I'm on that particular point, I'm particularly optimistic. Also, I happen to believe, thanks to Darwinism and the kind of falling away of the lower quality kind of listed PE universe, the group that exists now, and I've personally invested across the majority of them, are a really high quality group. These are well-run investment companies like, kind of Oakley Capital Investments, OCI, which has generated compounding returns over the last 4 years of 24%. And that's been reflected in the share price. The growth of the underlying assets is what drives the share price. A share price that's up, 135% over that period of time. And, that's one of the best performing in the listed PE sector. But the performance of the others in the sector, kind of are equally strong. And I'd encourage anyone to kind of, if you haven't, take a look at the cohort. There will be sectors and areas of specialism which you maybe can't access, but maybe you want to access fintech or biotech or etc. Now, clearly the risks are with choosing the right manager, looking at history as a precursor to future performance, and understanding the sectors that they're going to expose you to. Great.
Steven, unfortunately, we've run out of time. There was a very quick question from James just about, if you can answer that in 30 seconds, how can investors learn about and do due diligence on the investments included in Oakley's portfolio?
Well, because we're listed, we have to provide, we've got an investor center, oakleycapitalinvestments.com. And, kind of like our peers, there is a lot of information about how we invest, what we invest in, and the underlying businesses. Plus, we now do results webinars twice a year. We have a capital markets day that anyone can dial into. And so we provide increasing amounts of information on the website, fact sheets and reporting to provide exactly that insight.
Fantastic. I'm afraid that's all the time we have for now. Thank you, Steven. Thank you so much for being such a fantastic guest. and for sharing your brilliant insights. And to all of you for tuning in. I hope you enjoyed it and took away something from the session, because I certainly have. Don't go anywhere, because the next session, the DIY Investor Revolution with Lane Clark, co-founder of TPP, will be up next in 15 minutes. See you at the next session, and have a great day.